Office of the Auditor General of the Federation has identified 28 major financial infractions involving Nigerian National Petroleum Company Limited, detailing questionable payments, undocumented expenditure, and regulatory branches amounting to 61.1 billion naira when converted from multiple currencies. Welcome to Business Point, where we extract the Nigerian economy and the government policies. I am Kike Lomo Okere. The findings are contained in the Auditor General's 2022 Annual Report on Non-Compliance, Volume 2, covering transactions executed during the 2021 financial year across NNPCL and its subsidiaries. The report, now before the National Assembly, outlines weak internal control, unauthorized transfer of funds, tax violation, irregular procurement process, abandoned projects, and unsubstantiated payments. This latest revelation adds to a historic of discrepancies previously flagged in the Auditor General's report from 2017 to 2021, when NNPCL was linked to diversion or mismanagement involving 2.68 trillion naira and $19.77 million over 4 years. A major red flag involves 14.32 million euros spent at NNPCL's London office without supporting documentation. Although classified under personal contract and operational costs, auditors reported that no records were provided to verify utilization or compliance with financial regulations. The Auditor General noted that the lack of documentation indicated serious internal control weaknesses. However, NNPCL management responded that the London office operates with an approved budget and maintained detailed records, adding that the audit query did not specify the exact items in dispute. Auditor General, however, dismisses the defense and sustained the query, directing the Group Chief Executive Officer appear before the Public Accounts Committees and urging recovery of the funds. The audit also flagged 5.6 million euro paid to contractors without evidence of engagement, alongside several dollar-dominated issues. Other findings include undocumented, reimbursable, questionable consultancy payments, non-deduction of mandatory taxes, and contracts executed without evidence of delivery. The audit also highlighted a high-risk cross-MDAs issue involving 6.24 billion naira paid without documentation, with NNPCL accounting for the largest portion. Anti-corruption advocacy groups described the findings as evidence of entrenched opacity within NNPCL. Analysts argue that despite the Petroleum Industry Act's promise of commercialization and transparency, the company remains shielded by powerful networks inside and outside government. They criticize weak oversight from the Presidency, National Assembly, and security agencies, and urge stronger action to dismantle interest within the national oil company. The infraction occurred during the tenure of the GCEO Mele Kyari, who served from 2019 until his removal early this year. Here are some short analyses about the report. The audit report exposes deep-rooted structural weaknesses within NNPCL, pointing to recurring pattern of poor documentation, weak oversight, and irregular financial practice. Despite ongoing reform, its transformation into commercial entity under the PIA. The breadth of the infrastructure, from procurement abuse to tax failure and undocumented foreign payments, signals a governance problem that extends beyond individuals' actors, reflecting systematic vulnerability that have persisted across multiple administrations. Unless enforcement action follows, recoveries, sanction, and strict oversight, the cycle of the financial opacity within Nigerian oil sector is likely to continue. States across the Federation are carrying a combined 1.06 trillion naira in unpaid obligation to contractors and retirees even after receiving unprecedented revenue inflow in 2024. The latest figure from the Budget 2025 State of State report shows the lingering weight of subnational debt despite rising federation allocation and increased internal revenues. Contractors' arrears totaled 434.87 billion naira, while pension and gratuity backlog amounted to 626.81 billion naira. 30 states recorded debt in one or both categories. Only Borno, Kano, and Nasarawa ended 2024 without any outstanding obligations. Kaduna emerged as the most indebted state, owing 139.636 billion naira in combined arrears, minus 56.07 billion naira to contractors and 83.29 billion naira in pension liabilities. The highest pension backlog nationwide. Ogun followed with 107.18 billion naira, driven by 81.54 billion naira pension deficit. Benue ranked third with 99.68 billion naira in combined arrears, largely from 72.25 billion naira pension backlog. Edo State reported 95.46 billion naira, while Enugu recorded 19.18 billion naira. Other states with heavy burdens include Imo with 57.25 billion naira, Akwa Ibom State with 43.71 billion naira, Delta with 42.35 billion naira, Oyo State with 41.97 billion naira, and Plateau with 40.98 billion naira. These 10 states alone account for nearly half of the national arrears. At the lower end, Kano and Nasarawa states reported zero liabilities. Lagos State recorded only 48.74 million naira in contractors' arrears and no pension backlog, placing it among the least indebted. Ebonyi, Borno, Jigawa, Katsina, Yobe, Ondo, Kogi states rounded off the states with smallest arrears. Budget assessment excluded Rivers State because the political crisis and nullified 2024 budget prevented the production of the audited statement. For the 35 states analyzed, total liability stood at 1.24 trillion naira, when salaries, judgment, debt, and other claims were included. Salary and staff claims amounted to about 33.74 billion naira, judgment debt to about 62.33 billion naira, and other liabilities to 73.25 billion naira. A deeper review shows a worrying trend. 4 states, Kaduna, Benue, Adamawa, and Taraba states, owe more in contractors and pension liabilities than they generated internally in 2024. Kaduna's arrears more than double of its IGR, while Benue were nearly 5 times higher. Adamawa pensions arrears exceeded its IGR by over 1/3, and Taraba outstanding obligation surpassed its earning by roughly 46%. The pension burden remains particularly heavy because only 70 states have fully implemented the contributory pension scheme. 12 have not been begun, and 7 are still setting up the necessary structure, leaving many retirees dependent on irregular payments and decades-old gratuity promises. These consequences are visible nationally. Contractors and pensioners continue to stage demonstrations, including the recent blockade at the National Assembly over alleged multi-trillion naira federal debt. The budget findings highlight deep structural weaknesses in state finances, while revenue surged in 2024. Arrears persisted because many states continue to allocating a large share of funds to recurrent costs, personal overheads, and political spending rather than settling legacy obligations. Pension arrears in particular expose long-term sustainability risk, especially in states where IGR is too small to cover basic obligation. Without reforms to improve revenue efficiency and enforce pension compliance, states risking slide into cycle of debt accumulation, stalled projects, and worsening public trust. The Federal Inland Revenue Service has dismissed claims surrounding the appointment of express payment as part of the National Revenue Collection structure, describing the allegation as misleading and capable of dragging a routine administrative function into political controversy. The agency clarified that it does not operate a single gateway system for tax collection and has not granted any private company exclusive right over government revenue. Instead, the FIRS runs a multiple-channel payment framework supported by several long-established payment solution service provider, including QuickTeller, Remitter, eTransact, Flutterwaves, and ExpressPay. This model is intended to expand access, enhance convenience for taxpayers, and strengthen efficiency across the collection chain. The service stressed that the PSSP are not collection agents and do not receive process fee or revenue percentage. All payments made through this platform moves directly into the Federation account, ensuring that government funds remain secure. According to the agency, the multi-channel approach improves monitoring, reporting, accuracy, and innovation while supporting competition and job creation within the fintech sector. It's also noted that onboarding new platform follows a transparent and variable process. The FIRS pointed to the ongoing national tax reform led by Presidential Committee on Fiscal Policy and Tax Reforms, describing them as vital to modernizing the country's fiscal framework. It cautioned that this reform should not be undermined by politics, narrative, or misinformation. The agency urged political actors to avoid misinterpreting standard administrative processes, noting that the tax administration system played too critical role in national stability to disrupt by unnecessary controversy. The FIRS response reflects growing sensitivity around revenue administration at a time when the government finances are under intensive public scrutiny. By emphasizing transparency and multi-channel system, the agency is attempting to counter narrative that could erode confidence in tax processes or suggest preferential treatment for private firms. The pushback also signals broader concern about political narrative influencing fiscal reform that are central to government revenue performance. The Dangote Group has announced a major push to reduce Nigerian dependency on imported sugar through a more than $700 million expansion program designed to strengthen local production. The investment to be undertaken by Dangote Sugar Refinery covers land development, economic acquisition, infrastructure upgrades, workforce training, and community engagement. The goal is to build a domestic supply chain capable of producing sufficient raw sugar to meet national demands and support future manufacturing growth. The company outlined the plan at the 2025 Lagos International Trade Fair, linking the rollout to its broader backward integration strategy. As part of the effort to improve market access, and the refinery will introduce a range of retail sugar packs in 100 grams, 250 grams, and 1 kg size for household and small businesses. The Group Executive Director of the Commercial Operation highlighted a wider objective of strengthening Nigerian industry base by keeping more of the value chain within the country, noting that the industry expansion remains critical for job creation and for supporting smaller businesses that rely on stable local supply. The initiative was also tied to the group's ongoing project in refining and fertilizer and petrochemicals, underscoring its push to deepen local manufacturing capacity across sectors. Dangote Sugar Refinery remains Nigeria's largest producer with an installed capacity of 1.44 million metric tons. Its financial performance was also shown significant improvement. Revenue for the first 9 months of the 2025 rose to 626.24 billion naira from 484.42 billion naira in corresponding period of the previous year, while losses narrowed sharply to 10.59 billion naira compared to 184.4 billion naira recorded in 2024. Dangote's $700 million commitment signals a strong vote of confidence in Nigeria industrialization and agenda and aligns with the national effort to cut food import bills by expanding backward integration and boosting raw sugar production. The group is positioning itself to stabilize supply, broaden consumers' access, and strengthen local manufacturing ecosystem. The narrowing losses also suggest that the refinery is beginning to benefit from earlier investment and operational reform. All right, let's take a quick short break now. We will be right back. Don't go away. Please stay with us. Welcome back. If you're just joining us, it's Business Points, where we extract the Nigerian economy and the government's policies. The Naira closed the week weaker at both the official and parallel foreign exchange markets, extending the pressure that has trailed the currency in recent session. At the Nigerian foreign exchange market, the Naira depreciated by 0.99% to 1,456.72 Naira to a dollar on Friday, down from 1,442.43 Naira to a dollar the previous week. In the parallel market, it traded between 1,470 Naira to a dollar and 1,475 Naira to a dollar. Market analysts reported wider fluctuation at the official window, with the currency moving between 1,440 and 1,460 Naira as reduced inflows met firm dollar demand. By week end, the Naira had shared nearly 1% at the official market and slipped marginally at the parallel market. Investment firm tracking the market noted that strong early demand from the investors and elevated dollar needs continue to weigh on the currency. Despite multiple interventions by the Central Bank of Nigeria, the pressure persisted throughout the week and continued to the weakening of the exchange rate. The broader FX market reflects a combination of volatility and strengthening buffers. Nigeria's external reserve rose from $43.64 billion on November 14 to $44.19 billion by Thursday, a 1.26% increase. Analysts attributed this improvement to stable oil earning, rising non-oil inflow, and sustained trade surplus, factors that helped reinforce the CBN effort to maintain liquidity and market stability. Looking ahead, analysts expect the market to take a cautioned approach. Forecast indicates that exchange rate movement will largely mirror the strengthening of inflow rather than speculative activities, meaning pressure on the Naira may persist unless supply conditions improve. Nonetheless, this build-up in reserve and continued CBN intervention are expected to moderate volatility. Some investment houses maintain a positive near-term outlook, projecting relative stability as reserve grow. Others anticipate that the Naira will trade within a similar band in the coming week, supported by bullish short to medium-term fundamentals, including the CBN's market reform, which have contributed to recent disinflation. Analysts also link the currency performance to wider policy expectations, suggesting that the Monetary Policy Committee meeting this week may adopt a softer stance. A modest of 25 to 50 basis point cut is anticipated, a move expected to extend the rally in the bond market and limited impact on equities. The Naira depreciation underscores the persistent demand-supply imbalance in the Nigerian FX markets, even as external reserve continues to grow, while CBN intervention and improving reserve level offers some cushion. Underlying structural pressures, strong dollar demand, uneven inflows, and investors' positioning remain influential. The upcoming MPC decision may provide short-term direction, but sustain stability while dipping on improving FX supply, strengthening confidence, and maintaining policy consistency. All right, before we call it a wrap on Business Point this morning, let's take a quick look at the stock market. The bearish momentum in the Nigerian equity market intensified last week, wiping out 2.1 trillion naira in 5 trading sessions as persistent sell pressure and weak demand pushed major indicators deeper into negative territory. Market capitalization fell to 91.41 trillion naira from 93.50 trillion naira, while all-share index declined by 2.2% to 143,722.62 points, extending the market's downward trajectory. Analysts link the slump to continued sell-off in high-volume and bellwether stock, and investors trade cautiously ahead of the year-end portfolio adjustment. The mood remained risk-averse, with traders prioritizing capital projection amid tight liquidity and limited positive triggers. Market activities also weakened sharply. Investors traded 2.668 billion naira share, worth 106.26 billion naira in 7,998 deals, a significant drop from 7.325 billion shares valued at 156.43 billion naira recorded the previous week. The financial service sector dominated activities, accounting for 1.82 billion shares worth 44.81 billion naira, representing 62.21% of total volume. All right, this is where we'll call it a wrap on Business Point today. Join me again tomorrow on Global Television, channel 365 on DSTV and 276 on Star Times. To stay connected, kindly follow us on all our social media platforms using at Global TV NG. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.